Joseph, the big story of the week has been the oil price, which is falling heavily on the back of the OPEC summit earlier this week in Vienna. One of the countries most exposed to the oil price is Russia. How are things looking for Russian companies?
Yeah, it's ironic because Russia isn't a member of OPEC, and yet its equity market has always been seen basically as a gigantic proxy for the oil price, considering the biggest companies by market cap there are Rosneft, Gazprom, and banks like Sberbank, which pretty much just lend to the oil sector. So if the oil price goes, they'll go with it. There's a slight complication because the ruble has been falling. That weakens the impact, at least for the Russian government's tax revenue, of falling oil prices. But yeah, you have to wonder, does Rosneft at a price to earnings ratio of about 5 times next year, or price to cash flow of about 2 times, also on next year's numbers, kind of reward you for taking that risk?
Well, it certainly looks very cheap, although it could be a value trap.
Yeah, well, as Rob always says, Russia is the place where single-digit price-to-earnings ratios just go to die. It's like, traditional valuation techniques can be very misleading, and you have to realise, as well as oil prices falling and sort of limiting cash flow for companies, Russia is still subject to financial sanctions from the West. So, a few banks cannot refinance either in equity or in bond form in Western capitals. And so debt really begins to complicate those valuation tools as well.
How is debt looking for these companies?
Well, there are about 32 companies, according to Bloomberg, which have sort of net debt to EBITDA ratios of more than 3 times. I mean, that can be slightly complicated in itself because one of those companies is Rusal, the aluminium producer, and its stock has just taken off this year, in part because aluminium prices have recovered, but also because it's actually already been restructuring its debt. Others aren't the same though, and that is really a problem for banks if you're investing in them. Sberbank has a return on equity of about 15% still, or that's what it's targeting, which is pretty good, but it's having cut it from 20%. And loan provisions are already rising. They'll continue to rise, and that's the problem. When valuation becomes slightly useless, you just have to think about when and where does the debt get sorted before you're kind of comfortable buying.
So that's a concern for anyone who's thinking of investing. I guess even at these depressed levels, the valuations are still subject to whatever the oil price is doing. Joseph, thanks very much.